Hey everybody, welcome back to Is It a Buy, where we discuss stocks and determine if they are worth a buy or maybe a pass. My name is Corey. I just like to preface the video by saying I'm not a financial advisor. I'm just a guy who likes to talk about stocks, so please take that with a grain of salt, all right? Another disclosure, I do have a large stake in AMC, so full transparency there. Take that for what it is. So my last video has been a wild ride. Essentially, what is going on is we're talking about the Class A common stock. So a lot of confusing information. I try to do some clarity, but there's still things that need to be cleared up. So I decided I'm going to call somebody. I went ahead, I called an investment advisor, and he walked me through everything. Now I'm going to be showing maybe clips of the video. Obviously, there are parts of the video that I'll have to cut out to conceal identities, but hopefully this video will clear up some questions from an actual representative from a large company. So here we go. So basically, I have a small YouTube channel. I'm trying to just do a little bit of research on what's going on. So essentially, what's driving my question is AMC recently announced that they were going to be issuing Class A stock. I'm getting it pulled up right now. And I'll read you the exact verbiage. So, okay, here it is. So they're going to be increasing the total number of shares of Class A common stock by 500 million. What does that mean?
Okay. So, Corey, imagine you owned a house.
Okay.
Okay, and you have a mortgage on that house.
Mm-hmm.
Let's say you've owned the house for 10 years or something like that, and you originally bought the house with a first mortgage of $100,000.
Mm-hmm.
Okay, and that's what the house is worth, $100,000.
Mm-hmm.
Okay, fast forward 10 years later, now the house isn't worth $100,000; it's worth, let's say, $500,000.
Mm-hmm.
Okay, well, let's just say, okay, you have $400,000 worth of net worth or equity. You have $400,000 worth of equity in the house, and let's say you wanted to use that equity. What if you wanted to let's say you wanted to buy a new $30,000 car.
Mm-hmm.
Okay, well, to unlock the equity for a purchase in that home, you would have to sell the home, right?
Okay, right.
To sell a home to buy a car, right? So instead what you do is you go, okay, instead of selling my home, I'm going to go to the bank and get an equity line of credit.
Mm-hmm.
Right, and that's similar to a credit card. It's a line of credit that goes up and down as you borrow against it and as you make payments down on it. And the interest is calculated on the balance of what you owe.
Okay.
Instead of like your first mortgage, which is a fixed payment, right?
Right.
So that's essentially the way stock works. Okay, stock basically is that home equity line of credit. It provides flexibility. You can issue shares. You can buy back shares. Basically borrowing against or paying down the balance on your home on the line of credit. Okay, so if you look at it that way, a Class A and a Class B would be as if you went to a bank and you said, I want a home equity line of credit, and then they give you an equity line of credit. Let's just say $30,000.
Mm-hmm.
Right? Again, you got $400,000 worth of equity in that home, and you spend every dollar of that $30,000 on that new car.
Okay.
Well, what if you go back later and say to yourself, gosh, I got $400,000 worth of equity in the home, and I only tapped my home equity line of credit for $30,000. What if I need additional funds? Well, what if you went to another bank and you got an additional home equity line of credit, this time for a different total amount? So the first one was $30,000. What if they just give you, let's say, a $200,000 line of credit? So
Mm-hmm.
now what you're left with is, one, you have your mortgage. Two, you have that original home equity line of credit. And now you have a third home equity line of credit. Okay, the
Mm-hmm.
Class B shares are like that second home equity line of credit.
Okay. So let me ask you this. What kind of stock are we trading?
Well, right now, if they only have a Class A share, then that's what you're trading,
Okay.
right? Typically, if a company has a Class B,
Mm-hmm.
it will trade under a different ticker symbol. So a good example of a company that has a Class B share is Berkshire Hathaway. They have a Class A and a Class B. The Class B shares arose because of a strange um, numerical phenomenon that occurred around the Santa Fe Railroad acquisition. The original Class A shares of Berkshire Hathaway were valued at too high of a price,
Mm-hmm.
so that Berkshire Hathaway had to create a Class B share of a lower value, so that they could complete the purchase of Burlington Northern Santa Fe.
Mm-hmm.
So essentially, and then Google did a Class A and a Class B. Okay, but they basically separated out their company, right? Class A shares have access to a certain type of income stream within Google,
Mm-hmm.
and then Class B shares are entitled to a separate thing altogether. So basically, Google's found themselves in the position that they basically had two business types, and they decided to section off the business into two businesses.
Okay.
Within the
Mm-hmm.
Berkshire Hathaway example, there wasn't a sectioning off of two businesses. It was the same equity, same business, just two different share classes.
Okay, I understand. So in the case of AMC, since the ticker is AMC, you're saying that all of the shares are Class A common stock.
Correct.
Oh,
Well, yes. Yeah, it would be their initial, yeah, yes, in short, yes.
okay,
They
yeah.
don't call it Class A. Yeah, but ultimately that's essentially what it is. They only have one class of equity ownership.
Okay, so everybody is essentially Class A. So let me ask you, if so currently, so if they want to add the 500 million shares, and it says the new total would be over 1 billion, so basically doubling what the shares are, what would you say that would do to the stock? Like for example, would it dilute the stock or anything? Would the price go down, or I can't tell if this is a good or a bad thing.
Okay, yeah, it's neither. Okay.
Okay.
So go back to our example with the home equity line of credit. Okay.
Okay.
Let's say you did exactly what I described, where you get a first mortgage, then later attach a $30,000 line of credit, and then a $200,000 line of credit. Okay. Let's say you structure that. You go to the trouble of structuring that.
Mm-hmm.
What does that structure have anything to do to the value of your house?
Okay, I see your point.
Yeah, so essentially what happens is you go out and get the line of credit. It changes your equity. It changes your cash position, right?
Mm-hmm.
Because you now have less equity in the home. You have
Mm-hmm.
more equity in your checking account, right?
Right.
That ultimately doesn't have anything to do with the value of the assets. Ultimately, that's all about the underlying earning power of the business, and that's not really something, like I don't know what that is.
Okay. So let me ask you this, and I'm not sure if you can answer this, but are you allowed to speculate, like why would a company typically do this?
Yeah, it's really simple,
Okay.
right? Well, there's really two answers
Okay.
that need to consider. One is, hey, they just need to refinance some of the underlying structure of their business, right?
Mm-hmm.
They're really just moving money from one place to another.
Mm-hmm.
Mostly because they need the cash. They need cash. Why? Because their business is struggling, right? The revenues aren't where they used to be. So they can go out and tap the market for additional cash so that, they can stay afloat, right?
Right.
So that's one thing to consider, is that they need, again, let me just start again. One, they want to buy something, right? Just like in the example of the house, you want to buy a car.
Mm-hmm.
Well, whether or not buying a car is a good investment is a whole other thing, right?
Right.
What kind of investment is a car? It's not really an investment unless you know something about that particular car, right? So like
Mm-hmm.
for me, like if you go onto the auto dealership and you buy a car, it's probably not a good idea because you're typically paying more for the car than what it's actually worth.
Okay. Right.
Right. But if I go to an auto auction and I buy a car for a third of its retail value, and then later sell that car for more than what I paid for it, then it's a good investment. It's a good idea. But another thing that can happen is I can go out and I can borrow that money and I can waste it essentially. I can go out to eat. I can basically spend the money on things that don't generate a capital return.
Right. Okay. I see. So.
Yeah. But so typically I'll tell you this though, when a company goes public with its shares,
Mm-hmm.
let's say you owned, and these are insiders that are making this decision.
Mm-hmm.
So bear that in mind. This isn't people who don't know anything. These are people who actually run the business. Okay. Let's say you were you were the CEO of a multi-million-dollar corporation.
Mm-hmm.
Okay, and you saw in the market that your share price was $10. Okay.
Okay.
But from your own internal calculations, the share price should be somewhere around $100.
Right.
Okay. Would you dilute your shares in that case? If you really believe that your business was worth more than what the market said, would you go out and sell something for less than what it was worth to you in your own mind?
Right. Absolutely not.
Yeah. So if the very company that you're buying shares in are selling those very shares,
Mm-hmm.
well, I can't really say it's a good or bad thing because I can't really comment.
Right.
And I don't know. It could be the best deal going since Facebook for all I know.
Right.
Whatever.
Mm-hmm.
But logically, if it was the next Facebook, the current management wouldn't be trying to tap the market by diluting their own equity ownership stake.
Okay. Right. So it could be either way. Does it? So let me ask you this: could you speculate that it just depends on their reasoning, or what would you say about that?
There's no way to know, right?
Right.
So, like if you go to buy a car from somebody, like on Craigslist or whatever, and you're negotiating with the current owner, okay, they're selling the car,
Mm-hmm.
right? Is it best in most cases to assume that there's something wrong with the car and do proper due diligence, or is it a good idea to just assume that they're telling you the truth at all times?
Yeah, that's a great example. That's a great example. You always want to do your due diligence.
Right.
Absolutely.
So if you don't, so let's just say you have two mistakes that you could make there. One of omission and commission. So like you could omit the due diligence and hope everything works out,
Mm-hmm.
or you could do diligence every time and then everything would work out.
Right.
But rather than hope everything works out, you do your due diligence because even though it takes more time, you avoid costly errors.
Yeah.
Avoid out all the times that you make a good decision. So in other words, if the guy's selling me something, ultimately it's a tough sell to me from an intellectual standpoint, just because you're selling the thing I'm buying.
Mm-hmm.
I'm immediately going to be skeptical. That doesn't mean it's always a bad deal. It just means that, if you don't do your due diligence every time, then you will eventually make a decision that is bad, and that will probably negate all the good decisions you make.
Yeah, that's
like if I buy, so for example, like if I buy a car, right,
Mm-hmm.
and let's say I hope to make $1,000 by flipping that car, right?
Mm-hmm.
So I buy it for $5,000, and then I later sell it for $6,000, and that's my average gain. It's $1,000.
right.
Okay, if I buy one bad car and I lose most let's just say I lose all the money in that case. I go to zero.
Mm-hmm.
Well, one bad decision negates 5 good decisions. So,
Mm-hmm.
I mean, that's probably more than you wanted to know. But ultimately, the key thing there is I can't really comment on whether or not it's a good or bad deal. But if the very company that you own is selling its own shares, it's not always a bad thing,
Mm-hmm.
but it's immediately something that you should be skeptical of.
Okay, so would it be fair to say based on your conviction, so like it would be if you think that this company is a good company, you've done your research and you're confident that they're gonna be okay and their share price is gonna go up, don't be worried. But if you're skeptical about the company, you don't feel comfortable, about it. Number one, maybe you shouldn't be in here in the first place, and number two, just I guess keep your eyes open.
Well, so ultimately, the answer to that is always keep your eyes open.
Right.
Always kick the tires. Always look under the hood. The reality is, like, I don't know anything about AMC. I haven't done the math.
Mm-hmm.
But what is AMC worth? Okay, you can go through and you can actually precisely calculate what AMC is worth. People think that stock valuation is some magic. There's no right or wrong answer.
Right.
No,
Right.
there is a wrong answer and there's a right answer.
Mm-hmm.
The question is not. It's a matter of debate because there can be such a range.
Mm-hmm.
But if you can decide on what that range is ahead of time, what's an acceptable range for the future cash flows of AMC? Well, you can mathematically kind of estimate the low end and the top end.
Right.
Which means if you can estimate those two numbers, you can also estimate the value of AMC stock, from that perspective, from a low end to a high end. And you can say, okay, roughly AMC stock is worth X now, but given Y cash flows, or Y gap cash flows, you'll have Y gap stock valuation.
Okay. Right. I see. Let me also ask you this question. I think this might be my last question here. As far as now, as you may have heard with GameStop and AMC and all this stuff, they're trying for this short squeeze. Do you think these additional shares would have any effect on potentially doing that?
So short squeezes are conditions that ultimately what it sounds like to me is that the additional attention that the Robinhood situation and then the Wall Street Bet situation has created, essentially it's giving AMC the ability to raise additional capital because people are trading in shares more frequently.
Okay.
So they're saying, hey, let's take advantage of all this additional liquidity and let's go ahead and tap markets now.
Mm-hmm.
Because things could get better, yeah, but they could also get worse. So we're going to go ahead and tap for cash now while it's easy.
Okay.
Rather than wait for a financial condition to worsen. And so I'd rather have a bird in the hand now than 2 birds in the future if it means that I don't get anything in the future.
Right. Right. So essentially, this is a good way for them to raise capital.
Right. It's a way for them to raise capital, whether or not that impacts the whole situation with short sellers and whatnot. I wouldn't even know how to speculate how that will work out.
Okay. Fair enough. Fair enough. I just thought I'd ask. I appreciate you answering all these questions. I really appreciate your time. And that was the call. I thanked him for his time and hung up. So a few takeaways. According to him, as long as we are trading under the ticker symbol AMC, we are all trading Class A common stock. These additional shares are a way for the company to raise capital. And if it's a good or bad thing, that's up to you. Personally, I'm still bullish on AMC. AMC all the way. My conviction has not changed. That's what I have for you guys. Thank you so much for bearing with me. I know that was a very long call. I just wanted to get as much of it as I could just so that we can continue this conversation. Hopefully this investment advisor was able to clear up some of the questions and provide us with some real insight as to what this means for AMC. Obviously, at the end of the day, it is basically an interpretation, how you interpret this to be, if it's good or bad. Whether it will be good or bad is kind of in the future. It depends what the future holds. Thank you so much for watching. If you did like the video, please consider subscribing. I'm doing my best to give you guys the most up-to-date and best coverage of AMC that I possibly can. I do have a link for Webull in the description. If you do like using that platform, if you use my link and deposit $100, you do get 2 free stocks and I get a free stock. Also, if you wouldn't mind liking the video, it really helps with that YouTube algorithm and spreading the word about this stock, especially this kind of information. You heard it here straight from the horse's mouth, and I hope that that will help a lot more people make a decision on whether they want to stay in AMC or not. I don't really see that call deterring anyone from AMC. I think it'll just help them understand what is going on so they're not scared and they don't run. All right. Thanks again. I appreciate everybody's time with this issue. I just wanted to get to the bottom of it for a definitive answer. Again, thank you so much for watching. Have a great day. Peace.